Hello and welcome to a brand new episode of ET Market Smart Talk, a show where we engage with top experts to provide complete insights into current market trends and their impact on stocks and sectors. Well, I'm your host Shita Janand, and in today's episode, we are diving into the world of fixed income investing. And joining us today is Gautam Kaul, Senior Fund Manager, Fixed Income at Bandhan AMC. Welcome to the show, Gautam.
Thank you. Thank you for having me.
Thank you for taking the time out, Gautam. And so let me ask you, how does combining corporate bonds and arbitrage strategies help in creating a stable return profile for investors?
So I think you're referring to the new category where there's a fund of fund which feeds into arbitrage or non-directional equity as well as fixed income, right?
That's right.
The idea is to provide a stable return profile. For example, in our case, the Bandhan Income Arbitrage Plus feeds into the Bandhan Corporate Bond Fund to approximately about 60%, and the
Okay.
arbitrage fund to about 40%. So what you are getting is non-directional equity exposure, corporate bond exposure, which typically in our case the strategy is to manage it between the maturity of 1 to 4 years,
Sure.
and the cherry on top obviously is the tax advantage where after 2 years it goes into LTCG. So a
Okay.
much more efficient way of allocating to fixed income. The
Absolutely.
challenge we found that a lot of investors were facing is that while they wanted to allocate to fixed income, because of the change in tax since March 2023,
Hmm.
there was a hesitation to pay long term to pay short term gains even on long term investments. So this not only provides a stable return profile but also provides a much better post tax experience for investors.
Absolutely. And in fact, if you can also explain, what the Bandhan Income Plus Arbitrage Fund of Funds is and how is it differ from the traditional debt or the arbitrage funds?
Right. So this is the Bandhan Income Plus is a fund of funds. So essentially, for those who don't understand, a fund of fund is a fund which in turn invests in other funds. So
Okay.
you get a
Right.
combination of different funds in a single package.
Hmm.
Right.
Sure.
So in our case, the strategy is to allocate 35 to 40% of the inflows in the arbitrage fund, and the
Hmm.
rest in the Bandhan Corporate Bond Fund. And
Hmm.
like I said, the idea is to have a stable return profile, non-directional equity exposure, and our sense is that for most debt investors, a major part of their investment should be in broadly the, let's say, 1 to 5 year bucket, which should be the core of their long-term asset allocation.
Hmm.
And this fund of fund through the arbitrage plus corporate bond package provides that avenue in a more tax efficient manner.
Okay.
Our corporate bond fund is PRC rated. That means that the average rating of the portfolio has to be kept at AAA at all times. So
That's
the
right.
idea of the corporate bond fund itself is to have a very high quality liquid portfolio which provides you a
Mm,
stable experience. And
mm,
because it's corporate bond, the idea is that most times you'll get a spread over the sovereign curve.
sure. Absolutely. And let me also get your perspective on the interest rate movement. And we have already seen 50 basis but cut kind of a thing from the RBI, and the central bank is expected to probably cut further rates in the next 12 months or so. But how are funds like yours positioned to benefit or get impacted from a falling interest rate environment?
So, so Kshitij, what I find is that a lot of times, especially long duration fixed income, tends to be a tactical topic for investors, right? So, equity you can invest for the long term. Duration or bond investment is tactical. If RBI is cutting rates, invest and then you get out, right?
Right.
So I think one has to look beyond just rate. So rate cuts are obviously very important
Sure.
and a major means of the mark to market gain that an investor will have.
Mm,
But there is a lot more to the story, right? So right now, I would say the market is probably fairly divided into uh, if RBI requires to cut more, and if
mm,
uh, if there is a chance of a cut, when does the cut happen, right? That is one part of the story. The other part is to look at relative valuation and find points on the curve which offer
mm,
value even if there is not a rate cut, right?
mm,
So uh, when you think of fixed income, think of it in terms of a long term part asset
mm.
allocation part of
Okay.
investment, And then
Mm,
within that, yes, there are portfolio managers like us who would like to
mm,
exploit whatever value is available at various points in the curve.
mm,
Our sense is that as things stand, given the fact that chances RBI, the growth and inflation are both kind of undershooting the expectation,
right.
there is probably a chance to cut rates. More
Mm,
importantly, there's a fair amount of liquidity being provided by the Reserve Bank. Uh,
sure.
First via OMOs and then by the CRR cut, which goes into effect September onwards.
Okay.
What you should see is reasonable demand for both high quality corporate bonds and government bonds. And so, what we are thinking of it is that it's like a constructive portfolio construct where, depending on
Mm,
your appetite for duration, you could potentially, let's say, be in the 5 to 6 or 7 year GSEC or corporate bond category, or if you have a much longer investment horizon and more appetite for volatility, we
mm,
think the long term government securities offer really good value. So, something like a 30-year GSEC is where we think there is immense potential, not just as a tactical MTM play,
right.
but as a long term investment where you are looking to lock into somewhere close to, let's say, 7, 7, 10 and annualized 30-year for a government of India credit.
Mm,
So, those are
absolutely.
broadly the areas where we think there is absolute value.
Right. And Gautam, let me also get your perspective on the retail investor part of it. Yes, retail investors are pretty gung-ho on the equity part of it because we are seeing good amount of SIPs coming in, more than 27,000 thousand crores kind of money. But are retail investors showing interest in the short-term corporate bonds, or is it demand largely institutional? What are your views on that?
Well, I think what the industry has done a really good job of selling mutual funds, but also to some extent selling the idea and that you need to have asset allocation. A lot of these things in financial finance, which are boring, like asset allocation, are the ones which actually work in the long term,
Sure.
right? So,
Yes.
from that perspective, we are finding that retail investors are now starting to appreciate the fact that a long-term journey in equity and the compounding impact that it has is more important than probably having larger allocation. So you need to have the correct asset allocation so that your compounding journey is not uh, broken at the wrong time. Plus, you need a stabilizer for a portfolio, right? So fixed income, the need is felt. There was some hesitation, like I said earlier, because post-tax experience wasn't that great. But with this new product, we find that there is traction both from retail as well as institutional investors. Now, if you look at absolute numbers, obviously the institutional investors stand out in terms of the ticket sizes that they can allocate in. But
Mm,
in number of investors, we are finding that not this product in particular, but even otherwise, right across categories from short-term corporate bond fund to even, let's say, a gilt dynamic or a long duration fund category. Both retail and HN investors are starting to come in in much higher numbers over the last 6 months or 1 year.
absolutely. And for investors, especially the retail ones, and if you can give them a small masterclass as to how to rate cuts affect investors' demand for different tenures of corporate bonds. I'm sure a lot of new investors or the Gen Z ones, you could say that, might not be able to relate too much, and there's more fear rather than the accurate knowledge as to how bonds work. So if you can sort of simplify this equation for them, it'll be really great.
Basically, when you are investing in a fixed income instrument of any sort, there are two broad looks that risks that you are running, or things that will
Mm,
influence your return. One is the duration on the bond. Other is the rating. The rating means the credit risk that you run on the bond. Duration
mm,
means the weighted average maturity of all the cash flows of the bond. So, for simplicity's sake, uh, let's just say the sensitivity of a bond's price to interest rate movement is measured in duration,
okay.
right? So, for example, if a bond has a duration of one, then for a 1% change in yields, the price of the bond will fall or rise by 1%,
Okay.
right? So, 1 into 1. Similarly, if the bond has a duration of 10, then the price of the bond for every 1% change will fall or rise by 1% in this case. So, it will be for a 1% change, there will be a 10 rupee impact, plus or minus. right?
Mm,
So there's a little more nuance to that, but this is broadly the principle.
mm,
Why is that important? Obviously, when interest rates rise or fall, the MTM impact on your portfolio is governed by the duration of your bond. Right?
mm,
And keep in mind, the return from bonds comes from two aspects. One is the coupon or the carry that a bond provides. Second is the MTM impact. So unless you are holding a bond till maturity, your holding period return for a bond is effectively till that point whatever is the coupon you earned on that bond,
mm,
which is a steady, which for most investors is the major part of the return, and steady accruing daily. But there's
mm,
also the mark to market impact. The mark to market impact is nothing but the impact of interest rate changes on your bond, right? So if like in my previous example, you have a bond with a duration of 1 and yields go down by 1%, you'll
mm.
have a 1% MTM gain. So you'll earn the coupon plus the 1% MTM gain if you decide to sell or realize that value on that particular day,
Exactly.
right? So when we talk to investors and try to advise investors on how to look at fixed income, one, look at duration risk. That essentially is how much volatility
Mm,
that a bond fund will have. Second, look at the credit risk that a fund has.
sure.
So these are the two major parameters on which you need to evaluate which funds to invest in. What SEBI has done is there's categorization in terms of duration
Mm,
of the funds, right from a liquid fund which cannot invest more than 90 days to a low
mm,
duration which can not go beyond 1 year duration or a short term. So you have categories where durations of the bonds are fund portfolios are defined, and
right.
therefore there's a very clear idea of the maximum and the minimum duration risk that you're exposing yourself to
Mm,
when you invest in that category. So this is not true for all funds, but a lot of funds you have a fair idea. For example, the short-term fund, the Macquarie duration has to be between 1 and 3.
mm,
So at best, I will be running a duration risk of 3, and at the lowest, I'll be running a duration risk of 1.
one. Okay.
Potentially for a 1% movement in rates,
Mm,
my mark-to-market gain or loss could be anywhere from 1 to 3 rupees or
exactly.
1 to 3%.
Mm,
Right now, in the past, what used to happen is that while figuring out the duration risk of a portfolio was easy, figuring
mm,
out the credit risk of a portfolio was much more difficult.
okay.
As investors, advisors had to go to fact sheets, open each portfolio, try to figure out what the long-term rating of all their assets are, and so on and so forth.
Mm,
A few years back, our SEBI introduced something called the Potential Risk Class Matrix or the
mm,
PRC Matrix.
right.
I don't know if you've seen it. It's
Mm,
it's it's very seldom that you find simple yet powerful tools. So
right.
this, I think, is one of them. So broadly, what it does is it will ask each fixed income fund to choose a
Mm,
matrix which defines the maximum risk that the fund will take on duration
sure.
and the maximum risk that the fund can take on rating.
Mm,
Right. So in one number, if let's say for example, I choose A, which is average AAA rating, which is
mm,
most of our funds, then I am pre-committing that on a daily basis, the average rating of my portfolio will be at least AAA, basis of scoring that SEBI is provided.
mm,
Right. Or for example, if I choose B, I am committing that the average rating of my portfolio at any time is at least AA. It
mm,
can be better, but the maximum average credit risk that you will take is that of a AA portfolio.
double. Okay.
So an investor, when he's investing in a fund, knows beforehand what is the maximum credit risk the portfolio can take and the maximum
Mm,
duration risk that a portfolio can take. Which are the two major risks that you need to, have a handle on if you're
mm,
allocating to income? And
absolutely.
so I think if nothing else, just look at the PRC of the fund and you'll have a fair idea of the maximum potential risk that you can take,
Mm,
which should be the your guiding light when you're allocating to fixed income.
right. Absolutely. And Beautifully explained there, Gautam, and I'm sure our investors would take note of that. Credit risk as well as the duration risk, both of these risks are very important. And PRC matrix, another keyword or another word, another metric that you need to manage. Apart from that, Gautam, looking at industry, if you sort of want to give an outlook, do you see Indian bond market emerging as a relatively safe haven amid the global debt uncertainties that are happening?
I'm sorry, I lost the audio of the last part. Can you just repeat the
Sure, sure. What I'm
question?
saying that do you see Indian bond market emerging as a relatively safe haven?
Oh, yes, absolutely. In fact, I would say we are, if not uniquely, one of the few economies which provides both macroeconomic stability as well as high yields. Right. So, to give you context, uh, what do long-term fixed income investors look to do? They look to maintain the purchasing value of their assets. Right. So, you want your fixed income assets to yield more than inflation. Right? That's the holy grail, and if you can consistently do that, you are maintaining the purchasing power of your money in whatever currency. Right. So essential for that is macroeconomic stability. So, for example, uh, one would want lower fiscal deficit.
Right.
One would want low inflation. One would want ideally low current account deficit.
Okay.
Right? So, India is one of the few countries which, at the current point, has a low and stable current account deficit.
Okay.
Is not as affected by tariffs as, let's say, a Southeast Asia or a China, which is a major manufacturing exporter. Our exports are services, right? As of now, most of the tariff talk is around manufacturing, right? So our export channel is relatively insulated.
True.
Our inflation is low, stable, lower than what RBI projected and much lower than what their target was. The government has been fiscally very responsible. They have been cutting down the fiscal deficit almost every year, except for a brief period in COVID. Even then, they were very careful about where they want to allocate and how they want to spend. And they've pre-committed to bringing down debt to GDP. Right? So these are all metrics which any fixed income allocator will look at. And so, if you're a global allocator, one, you started looking at India as a fixed income haven because we became part of the JP Morgan index. And even if it was not that, uh, if you leave out the name and you say, okay, there is one country where fiscal deficit is going to go, as last for 3 years has gone up from 5.5 to will potentially go up to 6.5, 7%,
Right.
and there's another country where fiscal deficit has gone down from 5.5% to 4.5%. One would assume that the one the fiscal deficit is going up is the emerging market, and the other is a developed market, whereas the reverse is true, right? So we are, uh, and look, all this is not by accident.
Hmm.
All this is a result of good policy. So if I'm a global fixed income allocator, then I want good policies which, in all likelihood, lead to good outcomes, as is
Right.
the case in our country. And this third interesting part is that the starting point for foreign ownership for Indian bonds is fairly low.
Okay.
So Indian government bond ownership by foreigners, even after JP Morgan inclusion, is less than 3% of outstanding.
Ah,
Most other EMs, it's anywhere between 5-7% to even as high as 15%. So
okay.
we, in my view, we provide a very attractive macroeconomic landscape for investor allocators to invest in,
Right.
and there is enough potential. The market is big enough, and there's low for ownership. So that, to my mind, can only go up.
Absolutely. And also, let me get your perspective on the ESG, one of the few words which have popped up in equity as well as in bonds as well. So, are investors sort of giving a valuation premium to companies issuing ESG compliant bonds, and what's driving the growing popularity of these instruments?
So ESG, this has been has that the movement has, and the market attached to it has acquired quite a lot of heft and momentum in the West, and we are still at very early stages of the whole
True.
ESG investing platform. I think even within our landscape, equity is where you are probably seeing more traction than fixed income. Although
Exactly.
what we have seen is that there are private corporates who are issuing ESG. In fact, Government of India also issues green bonds.
Sure.
So there is a concerted effort, and of course, there is demand for it as well from certain pockets. Uh, from the fixed income side, that market is still nascent, it's developing. We find that most ESG bond demand comes more from foreign investors rather than domestic ones.
Okay.
Uh, I'm sensing at some point in the future when there's more awareness, you'll probably have ESG dedicated funds in India as well, with Indian investors or foreign investors which are investing in ESG bonds. Uh, there is great potential, uh, but we are still at early stages. Is the market paying too much, a lot of premium for ESG bonds? Selectively, yes,
Okay.
but it still has to develop as a more widespread, more common practice. So,
Right.
to give you a sense, the government borrows the green bond, the borrowing cost for green bonds and regular bonds is not very different. You
Huh.
get probably a 5 basis point premium, but when it was first announced, our sense was that premium or greenium as it's called, would potentially be much higher, and that could still be the case, uh, because it's still early days of the market for INR bonds.
Right. Well, absolutely. Well, on that note, interesting conversation there, Gautam, and thank you so much for your time. And that's all for now. But do stay log on to ET Markets live stream more investment and trading ideas. Again, thank you so much for your time, Gautam. It was a fabulous conversation. Thank you for
Pleasure
your
talking
time.
to you. Thank you.
Thank you.